Imagine trying to lay steel railroad tracks, build a heavy locomotive, and write complex artificial intelligence scheduling software all at the exact same time.
Right, which sounds completely impossible.
It does. And you're doing all this while fighting the immutable laws of gravity and, burning through $80 million every 90 days.
Yeah, that's a multi-front war right there.
Exactly. That is the multi-front war you are watching unfold right now. Welcome to Talk Tickers, the professional earnings call summarization deep dive.
Vernacular.
Glad to be here for this one.
Today you are joining us to dissect a company attempting one of the most audacious, structurally complex transitions currently playing out in the public markets. We are talking about Firefly Aerospace, ticker symbol FLY.
It really is a remarkable pivot to analyze. I mean, you have a company that entered the public markets back in August of 2025.
Right, just a little while ago.
Yeah, and they were initially positioned and priced as a high beta space story stock,
which the market historically treats with a heavy dose of skepticism. Oh, absolutely, and rightly so. Hardware is unforgiving. Relying solely on a launch business inherently means your quarterly financials are entirely tied to, well, the volatility of weather patterns.
Right, or range availability.
Exactly, or highly sensitive engineering parameters.
Because rockets are notoriously difficult, building a predictable, cash-flowing business around them is, honestly, arguably harder than the physics of the launch itself.
Precisely the problem management is trying to solve here. What we are analyzing in their fourth quarter 2025 results is a fundamental architectural transformation.
They're trying to graduate, essentially.
Yes, aggressively attempting to graduate from that volatile, hardware-centric space story into a diversified end-to-end space and defense platform.
So they aren't just pitching the ability to reach low Earth orbit anymore.
No, they are pitching a comprehensive ecosystem. We are talking about a value chain that spans commercial lunar landers, national security orbital missions, and highly classified terrestrial and orbital defense software.
Wow. But before we get into the deep mechanics of those numbers, we need to do a quick vibe check on the market's reaction.
Yeah, the tape always tells a story.
It tells you exactly where institutional investor psychology is right now regarding this whole transition. The reaction is what I would classify as cautiously constructive.
That captures the sentiment perfectly, I think. If you watch the tape immediately after the numbers hit the wire in the aftermarket, the stock experienced this pronounced pop.
Like trading up roughly 6.5%, right?
Right. That was an algorithmic and retail reaction, completely driven by a substantial top-line revenue beat.
But then the adults entered the room.
Exactly. As institutional analysts digest the full print, and by the close of the following trading session, the stock had settled into a much more modest gain.
It held just slightly above 1%, I think, closing at $23.22.
Yeah, so the market is clearly rewarding the top-line momentum and the expansion of the backlog.
But that initial enthusiasm was heavily tempered by a very distinct, show me the execution attitude regarding their operating losses.
Investors are looking at the cash burn required to fund this multi-front war, and they are pumping the brakes on multiple expansion.
It's a classic valuation tug of war.
It really is.
Yep.
The top-line growth and the strategic contract wins, which we are going to discuss, are undeniably bullish indicators.
Sure.
But the fundamental ground-level reality of scaling heavy composite manufacturing down in Texas while simultaneously funding high-level clearance-required software development.
That's keeping a firm lid on the stock price.
Exactly. In the aerospace and defense sector, fighting a multi-front war on your balance sheet is usually where aspirational companies meet their demise.
But Firefly is bringing a very unique, highly capitalized arsenal to this fight.
They definitely have a war chest.
So the core question for you, the listener, as you dive into this analysis is this. Can a company simultaneously scale a hardware launch vehicle, build out a persistent lunar infrastructure franchise, and completely integrate a formidable defense software acquisition, all without exhausting its liquidity runway?
That is the billion-dollar question.
Let us unpack the results snapshot, starting with that top line, which was undeniably explosive.
Yeah, let's look at the numbers.
Fourth quarter revenue came in at $57.7 million.
Which easily cleared the consensus estimates that were sitting right in the mid-50s.
So we are looking at a beat of roughly $5 million on the top line in a single quarter.
Right. That represents a 541% year-over-year growth rate for the quarter.
That's massive.
Well, yeah.
And if you pull the lens back to look at the full fiscal year of 2025,
They hit a record $159.9 million in revenue, which is up 163% year over year.
incredible top-line momentum. But, experienced investors know that the headline number only tells a fraction of the story.
Always. You have to dig deeper.
To understand the actual health and the future margin profile of this company, you have to look under the hood at the revenue mix.
Yeah. And the mix here is fascinating. Out of that $57.7 million in the fourth quarter, an outsized $50 million came from spacecraft solutions.
Wait, $50 million just from spacecraft?
Yep. While only $7.7 million came from the core launch business.
That is a critical structural distinction for anyone building a financial model on this company.
It completely changes the game. See, the legacy launch business is highly event-driven.
Right.
Under generally accepted accounting principles, you generally recognize launch revenue at a point in time.
Specifically, when the rocket actually leaves the pad and deploys the payload into orbit.
Exactly. This makes the income statement incredibly lumpy.
I can imagine. If a sensor throws a faulty reading and scrubs launch on December 30th, pushing it to January 2nd,
That entire chunk of revenue shifts into an entirely different quarter.
it makes forecasting a complete nightmare for analysts.
It does. But that $50 million in spacecraft solutions represents a sequential bump driven primarily by an entirely different accounting mechanism.
You were talking about percentage of completion accounting, right?
I am, which is really the lifeblood of large-scale aerospace contracting.
Let's explain how that smooths out the financials for the listener.
Sure. So when Firefly is building a lunar lander or, say, developing a complex software architecture over a multi-year period, they don't wait until the final delivery to recognize the revenue.
That would look terrible on the books for years.
Right. It would look like they were making zero money. Instead, they use the cost-to-cost method.
Okay, how does that work?
As they incur costs like paying engineers, buying materials, passing critical design reviews with the government, they recognize a proportional percentage of the total contract revenue.
So it creates a much smoother, far more predictable revenue curve over time.
Exactly. It acts as a financial ballast against the volatility of the launch pad.
It demonstrates to the market that they can generate significant, predictable cash flow without necessarily needing to, light a candle on a launch stand every single month.
Which inherently lowers the risk premium attached to the stock.
That is the exact thesis management is trying to prove right now.
And it's working on the top line. Now let us move down the income statement to the bottom line where things get significantly noisier.
Yeah, the bottom line is a bit messy. They reported a non-GAAP earnings per share of negative 38 cents.
Which actually beat the street's expectation of a 48-cent loss.
So 10-cent beat there.
Yeah, providing a nice 10-cent beat. However, the GAAP EPS landed at a much better-looking negative 26 cents.
We really need to dissect that GAAP number because it looks artificially strong on the surface.
It does. GAAP numbers in the quarter of a major acquisition are always a minefield.
That negative 26 cents was heavily aided by some major one-time accounting items, wasn't it?
Oh, absolutely. First, they recognized a $37.1 million tax benefit linked directly to the recent acquisition of SciTec.
Right. And second, there was an $8.4 million gain from settling contingent liabilities.
Let's quickly translate what those mean for the valuation because it's important.
Please do.
When you acquire a company, you often acquire their deferred tax assets, or the acquisition alters your own valuation allowances against past net operating losses.
So that $37.1 million is essentially a paper benefit.
Completely. It makes the GAAP net income look a lot better, but it does not represent core operational cash flow.
The same goes for the contingent liability settlement.
Right. Exactly. It is a one-time adjustment, not a recurring revenue stream you can model out.
You have to strip those out to see the real operational heartbeat of the business.
Which is why the non-GAAP number is the one analysts are heavily focused on.
What does represent core operational progress, however, is the gross margin.
Yeah, this was a bright spot.
The gross profit actually flipped to a positive $16.0 million in the fourth quarter.
That represents a 27.7% gross margin.
If you compare that to the $20.2 million gross loss they posted in the exact same quarter a year ago, you are looking at a monumental swing in unit economics.
The gross margin improvement is highly commendable, but, and here is where we have to introduce the bearish counterweight to the narrative.
There's always a but in aerospace.
Always. That 27.7% gross margin is getting completely swallowed whole by the operating expenses further down the income statement.
Yeah, the GAAP operating loss for the quarter was $85.6 million.
That was significantly worse than the mid-60s loss that the analyst community was modeling for.
Furthermore, the free cash flow burn was severe.
Very severe. They burned through $79.3 million in cash just in the fourth quarter alone.
This metric right here is exactly why the stock could not hold that aftermarket pop we talked about earlier.
The retail investor sees the top line growing by 541% and buys the headline.
Right, but the institutional investor looks down the cash flow statement, sees nearly $80 million walking out the door in 90 days, and sells into the rally.
It tests your conviction as a shareholder.
It absolutely tests conviction, and management knows it.
Which is why they were very deliberate on the call in pointing out the balance sheet strength to reassure the market.
They exited 2025 with $893 million in total liquidity.
That war chest is massive. It's comprised of $793 million in pure cash and cash equivalents.
Plus another $100 million in short-term investments.
That liquidity profile is the bedrock of the entire company right now.
It is the floor that prevents the equity from completely washing out during these incredibly capital-intensive quarters.
And sitting on top of that liquidity floor is a $1.4 billion total backlog.
Which is up 22% year over year.
But to truly understand where the future margin profile is heading, and to understand what makes up a formidable chunk of that $1.4 billion backlog,
we have to look closely at the defining transaction of Firefly's corporate history thus far.
we need to talk about the newly closed SciTec acquisition.
Let's get into it. In October of 2025, Firefly announced the acquisition of SciTec, and they officially closed the transaction in November.
The total purchase price was roughly $855.6 million.
With $277.4 million of that consideration paid in cash, net of the cash acquired on SciTec's balance sheet.
Here is where we need to challenge the prevailing narrative a bit.
Right, because on paper, it seems like a very jarring pivot.
It does. Why does a hardware-focused, metal-bending rocket and lunar lander company decide to go out and buy a massive defense software firm?
Culturally and operationally, software engineering and aerospace hardware manufacturing reside in completely different universes.
To understand the why, you have to look deeply at what SciTec actually does.
Specifically, their foundational role in the United States Space Force's FORGE program.
Yes, FORGE stands for Future Operationally Resilient Ground Evolution.
Catchy acronym.
The DoD loves their acronyms. SciTec software serves as the absolute brains of the multi-orbit missile warning and tracking architecture for the United States.
Let's expand on the significance of FORGE, because this isn't some theoretical pie-in-the-sky software development contract.
Yeah, this is a deployed operational reality today.
In September of 2025, the U.S. Space Force operationally accepted SciTec's modernized AI-enabled architecture.
And in doing so, they broke a 50-year monopoly held by a legacy prime contractor for missile warning ground systems.
We cannot overstate how monumental it is to unseat a legacy prime in a domain like strategic missile warning.
It's almost unheard of. For half a century, the procurement paradigm was completely dominated by slow, cost-plus contracting with entrenched aerospace giants.
Ground systems were siloed, proprietary, and notoriously difficult to upgrade.
SciTec came in with a modern, cloud-native, open architecture framework.
And the real-world validation of that software was immediate and, frankly, profound.
You are referring to the recent geopolitical events in the Middle East.
Yes. During the recent conflict involving Iran, the 11th Space Warning Squadron actively utilized the FORGE system to provide real-time data.
This system processed over 1,000 discrete threat events during that highly volatile period.
We are talking about a system that ingests vast, unimaginably complex amounts of data from satellites in low Earth orbit, medium Earth orbit, and geostationary orbit.
It fuses all of that disparate sensor data together using artificial intelligence algorithms.
It filters out the noise.
Exactly, and then delivers high-fidelity, mission-critical, life-and-death tracking information to the warfighter on the ground almost instantly.
And the Department of Defense is compensating them accordingly for that level of performance.
As they should. The FORGE Enterprise OPR Services contract just saw a $19 million engineering change proposal,
bumping its total value from $263 million up to $372 million.
That's a massive bump, but the defense contract upside doesn't stop there.
SciTec brought roughly $170 million in immediate value to Firefly's total backlog, heavily diversified across strategic domains.
In the fourth quarter alone, they secured an 8-figure confidential U.S. software contract.
Specifically focused on time-dominant space control.
They also successfully onboarded to the Missile Defense Agency's SHIELD IDQ contract.
Let's explain that. An IDQ, indefinite delivery, indefinite quantity, is essentially a hunting license, right?
That's a great way to put it. Being on that contract vehicle allows them to bid on task orders under a framework that has a $151 billion ceiling over the next 10 years.
Wow. Furthermore, they completed key ground readiness reviews for the Space Development Agency's Tranche 1 tracking layer.
So we have this rapid influx of software revenue and government contracts integrating into what is ostensibly a rocket company.
Let's explain to the listener how this fundamentally alters Firefly's financial reporting.
Yeah, because software margins and the way they are accounted for are entirely different from hardware margins.
It changes the mechanics of their income statement significantly. This is crucial for anyone doing financial modeling.
With these government software contracts, the direct costs associated with executing the code, meaning the specific software engineers billing hours directly to Ford.
Those fall into cost of goods sold, or COGS.
Right. However, the indirect costs, the executive leadership, the facility overhead, the general enterprise software licenses, those hit selling general and administrative expenses, or SG&A.
Therefore, as SciTec becomes a larger percentage of the overall revenue mix, you're going to see research and development expenses optically decrease as a percentage of total operating expenses.
While SG&A will steadily increase, it completely changes the shape of the operating margin profile.
Okay, I have to push back here.
Go for it.
The narrative of blending a high-margin software business with a capital-intensive hardware business sounds fantastic when management pitches it on an earnings call.
It creates a great slide deck for sure.
Right. But in reality, software engineering and aerospace hardware manufacturing have fundamentally incompatible cultures, different development cycles, and vastly different capital requirements.
It's a valid concern.
Agile software teams operate on 2-week sprints, where failure is celebrated as a learning tool.
Whereas aerospace propulsion engineers operate on rigorous stage gate reviews where failure means a catastrophic explosion on the pad.
Exactly. Does mashing an agile AI software team into a deliberate, metal-bending rocket factory actually create true synergies? Or did Firefly just spend $850 million to buy top-line revenue, prop up their backlog, and try to re-rate their multiple to a SaaS valuation?
It is a highly valid skepticism. It is the exact question every institutional investor is trying to underwrite right now. Can they actually integrate the cultures?
It's a huge risk.
But if we look past the immediate integration challenges and connect this to the bigger strategic picture, the thesis management is executing on is the concept of space data centers.
Okay, let's unpack space data centers. This is the synergy they're claiming.
Right. SciTec has spent decades perfecting software applications and AI frameworks that operate on terrestrial servers to process missile warnings.
Meanwhile, Firefly is building the physical layer, the satellites, the orbital transfer vehicles, the landers.
By combining SciTec's software frameworks with Firefly's physical orbital assets, they're actively trying to create on-orbit edge processing.
Meaning the data doesn't have to travel all the way back down to Earth to be processed.
Exactly. Let's explain why that matters from a physics perspective.
It matters because of latency.
In the legacy architecture, a satellite detects a thermal bloom from, say, a missile launch. It sends that raw, massive data file all the way down to a terrestrial ground station.
Then that data is routed through fiber optic cables to a processing center,
where software finally analyzes it, identifies the threat, and then routes the alert to the relevant command center.
When you are dealing with hypersonic glide vehicles that can alter their trajectory mid-flight at Mach 5, every millisecond of that transmission loop is a liability.
So the space data center thesis eliminates the round trip entirely.
You process the raw sensor data directly in space, right on the satellite bus where it's collected.
You leverage the abundant solar power and the natural thermal cooling properties of the vacuum of space to run high-performance compute clusters up there.
The AI software identifies the threat on orbit.
And instead of beaming down terabytes of raw data, it beams down a kilobyte-sized alert. Hypersonic threat detected, heading here.
You drastically reduce the latency from the moment a sensor detects a threat to the moment a warfighter receives actionable decision-making intelligence.
This is the holy grail of modern defense architecture.
It taps directly into the Department of Defense's Golden Dome architecture, which analysts estimate has an addressable budget of $185 billion.
Firefly is betting that owning both the hardware in space and the software processing the data is the only viable way to capture that extreme value.
And that transition from defending the Earth from low Earth orbit using edge processing perfectly sets up their next frontier.
From the software margins and orbital data centers, we have to move out to the furthest edge of their hardware ambitions.
Which brings us out of low Earth orbit and into the cislunar economy.
Yeah, 2025 was a defining year for Firefly in terms of lunar credibility.
They achieved a milestone that fundamentally separates them from the crowded pack of aspirational space startups that, frankly, only have PowerPoint presentations to show for their funding.
We are talking about the Blue Ghost Mission 1.
They successfully executed the first ever commercial moon landing.
And this wasn't just a brief touch-and-go maneuver to claim the title. They completed a full 14 days of surface operations.
Let's contextualize the engineering required for that. Surviving on the lunar surface is exceptionally brutal.
It really is. During the lunar day, temperatures can soar to 250 degrees Fahrenheit.
The lander has to manage intense thermal loads while simultaneously managing 10 different NASA payloads.
They had to mitigate the highly abrasive lunar regolith, too. That stuff can destroy moving parts and obscure optical sensors in an instant.
And yet the vehicle remains stable, upright, and fully operational for the duration of the lunar day.
The industry recognition was substantial. They swept prestigious awards like the Robert J. Collier Trophy, the Jackson Aerospace Memorial, and were featured heavily in mainstream tech publications.
But as any seasoned investor knows, awards do not pay the bills.
They certainly do not. What pays the bills is a scalable pipeline, and Firefly is moving aggressively from a bespoke proof-of-concept mission to a standardized industrial cadence.
Missions 2, 3, and 4 are already actively in progress on the factory floor right now.
Let's break down that pipeline. Mission 2 is targeting a launch window between late Q4 of 2026 and early Q1 of 2027.
This mission profile is incredibly ambitious. They are carrying NASA payloads as well as the United Arab Emirates Rashid Rover 2.
And they are targeting the far side of the moon.
Which introduces a whole new layer of communications complexity since you do not have direct line of sight to Earth.
Exactly. And they have a formidable macro tailwind pushing this lunar cadence.
NASA Administrator Jared Isaacman has explicitly called for a monthly lunar South Pole mission cadence starting in 2027.
NASA views these commercial robotic missions as vital, expendable testbeds.
They need to refine hazard avoidance technologies, precision landing algorithms, and autonomous surface operations ahead of future crewed Artemis missions.
Firefly has already secured funding from the Texas Space Commission to expand their clean room facilities precisely so they can build multiple Blue Ghost landers simultaneously to meet this upcoming surge in demand.
So what do the actual financials of a moon landing look like?
Good question.
Historically, space exploration has been an absolute sinkhole for sovereign capital, let alone commercial capital. How is Firefly modeling the unit economics to actually make this profitable?
We are seeing clear signs of scale in the contracting. Blue Ghost Mission 1 was roughly a $100 million contract with NASA.
It was a foundational capability demonstration.
But as they move to subsequent missions, the revenue generated per mission is ramping up into the $150 million to $200 million range.
Walk me through the mechanics of that revenue jump. Why are they getting paid more for doing essentially the same thing?
Because they are stacking multiple revenue streams onto the same physical chassis.
Ah, I see.
They aren't just getting paid the baseline delivery fee by NASA for the primary payloads. They are actively acting as a lunar freight forwarder, adding commercial ride shares.
They are selling excess payload volume to international space agencies like the UAE, who want lunar access but don't want to spend billions developing their own lander.
Right, and perhaps most lucratively over the long term, they are beginning to commercialize and sell the data generated by the missions themselves.
And this brings us to one of the most mechanically fascinating pieces of hardware in their lineup, the Elytra Orbiter.
This is where the concept of spacecraft modularity really shines and drives margin.
For Blue Ghost Mission 2, heading to the far side of the moon, the Elytra Orbiter acts initially as the transfer vehicle.
It ferries the lander from Earth orbit all the way to lunar orbit.
But once the lander detaches and begins its descent, Elytra doesn't just burn up or become space junk.
No, it stays in orbit and functions completely independently.
It effectively becomes a long-haul communications relay satellite.
Because the lander is on the far side of the moon, it cannot transmit data directly to Earth. It beams the data up to Elytra in lunar orbit, and Elytra relays it back to the ground stations here on Earth.
But Elytra's utility extends far beyond just lunar support.
They recently completed the critical design review for a project called Sinequanon under contract with the Defense Innovation Unit, or DIU.
Which is the Pentagon's rapid acquisition bridge to commercial tech.
They are building a specific variant of Elytra tailored for dynamic space operations and rendezvous proximity operations, or RPO.
We really need to define RPO clearly because rendezvous proximity operations is going to be a foundational buzzword for space defense investing over the next decade.
Definitely. RPO means the satellite isn't just sitting passively in a fixed orbit, waiting its turn to pass over a ground station.
It has the chemical or electric propulsion, the advanced autonomous navigation, and the maneuverability to actively change its orbit.
It can chase down other satellites, inspect them with optical sensors to see what payloads an adversary might be carrying, or dynamically evade incoming debris or anti-satellite threats.
It is the literal securitization and militarization of the orbital domain.
Precisely. The physics of orbital mechanics dictate that you cannot simply point a satellite at another object and hit the gas.
No, you'd miss wildly.
Right. You have to execute complex phasing orbits, matching velocity and inclination perfectly to approach a non-cooperative target without causing a catastrophic collision.
Elytra is being built to master that exact capability.
And they are stacking commercial applications on the platform as well.
Elytra is slated to host the Ocula commercial imagery payload for high-resolution Earth mapping.
They also just completed a NASA study contract called Trinity, which evaluates using the Elytra platform for planetary defense.
Specifically, deep space reconnaissance of near-Earth objects, like potentially hazardous asteroids.
You know, the best analogy I can think of for what Firefly is building with this spacecraft segment is an orbital toll booth and delivery service.
Well, like that. They aren't just dropping off a package on the lunar surface and coming home.
They are leaving a highly advanced communications and compute satellite in orbit to charge for the Wi-Fi.
They are actively creating persistent, on-orbit infrastructure that generates recurring software and data revenue long after the initial capital-intensive launch phase is over.
That recurring revenue model is the exact transition required to survive and thrive in the commercial space sector.
You simply cannot survive on one-off hardware delivery fees alone. You have to own the infrastructure layer.
But, and this is a formidable but, none of these lucrative lunar contracts, none of the high-margin software defense wins, none of the orbital toll booths matter in the slightest if you cannot get the heavy hardware off the ground reliably and affordably.
You have to escape the Earth's gravity well first.
And that reality grounds us back to their hardware foundation, the Alpha and Eclipse launch vehicles.
This is where the thrust meets the pad, and where the bulk of their capital expenditures are currently directed.
Let's start with the critical success of the Alpha Flight 7 launch that occurred on March 11th, 2026.
This was a return-to-flight mission, which always carries immense existential pressure for an aerospace company.
It does. After experiencing an anomaly on a previous flight last year, Firefly did not rush a fix.
They initiated a comprehensive engineering and production stand-down.
They didn't just tweak a single valve. They stood up a dedicated reliability team. They analyzed vulnerabilities across every single department.
They implemented new automated launch abort parameters, reinforced stringent cleanroom contamination controls, and completely overhauled their launch day team training.
And that operational discipline paid off. Flight 7 was a flawless execution.
They deployed a test demonstration payload for Lockheed Martin right at the opening of the launch window.
Furthermore, and this is crucial from a technical perspective, they successfully proved out a second-stage engine relight of their Lightning engine in the vacuum of space.
Let's explain why relighting an engine in space is such a complex maneuver.
It's incredibly difficult.
When a rocket is coasting in zero gravity, the liquid propellants inside the tanks just float around in blobs.
If you try to ignite the turbopump while the fuel is floating, the pump might suck in a pocket of pressurized gas instead of liquid fuel.
The pump overspins, cavitates, and destroys the engine entirely.
To safely relight, you have to fire small thrusters called ullage motors to provide just enough forward momentum to settle the liquid propellants at the bottom of the tank right over the inlet valves before you ignite the main engine.
Mastering that sequence is crucial for precise orbital insertions into complex altitudes.
It is the ultimate test of automated flight software and fluid dynamics.
But they aren't resting on the success of Flight 7. They're immediately transitioning to the Alpha Block 2 upgrade, starting with the upcoming Flight 8.
This is not just a minor software patch. This is a major physical evolution of the launch vehicle designed to increase payload capacity and margin.
The Block 2 improvements are extensive. They are increasing the overall length and structural strength of the carbon composite tanks.
They are adding a thicker thermal protection system.
Which is necessary because they are targeting higher inclination orbits that subject the vehicle to much more intense aerodynamic heating during ascent.
They have optimized the propellant utilization and, perhaps most importantly for their supply chain independence, they have consolidated their avionics and battery systems entirely in-house.
And what's brilliant from a risk management perspective is how they tested this. They actually de-risked the new avionics on the previous flight.
Yes, they flew the new in-house avionics hardware on Flight 7 in what is known as shadow mode.
Meaning the systems were fully powered on, processing sensor data, and running the flight algorithms during the launch, but they were not physically connected to the steering actuators.
The telemetry from the shadow systems came back completely nominal, perfectly matching the legacy systems, giving them the data-backed confidence to make the hard switch for Flight 8.
They are also working to achieve outsized manufacturing efficiencies by utilizing automated fiber placement, or AFP, machines.
For those unfamiliar, building carbon composite rocket tanks traditionally involved teams of technicians manually laying down sheets of carbon fiber over a mold.
It is slow, labor-intensive, and prone to human error. A single wrinkle or void in the resin can cause the tank to burst under cryogenic pressure.
An AFT machine functions essentially like a giant, highly precise, robotic 3D printer.
It spins continuous ribbons of carbon fiber tape over a rotating mandrel, applying exact pressure and heat.
It allows them to build the structures much faster, with drastically higher quality control, fewer scrapped parts, and ultimately a structurally improved gross margin on the vehicle.
But the Alpha rocket is ultimately just their small lift vehicle. The real margin expansion in the launch business comes when you scale up your payload capacity to capture the mega constellation deployments.
And that brings us to the Eclipse medium lift vehicle. They are co-developing this larger rocket in a strategic partnership with aerospace giant Northrop Grumman.
The physical scale of Eclipse compared to Alpha is immense, but they are intelligently leveraging all the heritage technology, the carbon composites, the avionics architecture, and specifically the engine cycle to avoid starting from scratch.
They have already completed over 100 hot fire tests on the new Miranda engine that will power Eclipse.
Let's dive into the mechanics of that engine, because they utilize a tap-off cycle, which is relatively unique compared to the traditional gas generator cycles used by many competitors.
In a traditional gas generator engine, you have a small, separate combustion chamber called a pre-burner that burns a little bit of fuel and oxidizer just to create hot gas to spin the turbines that pump the main fuel.
It's complex and requires a lot of extra plumbing.
A tap-off cycle is much more elegant. It simply taps hot combustion gases directly off the side of the main combustion chamber and routes them to spin the turbines.
It drastically reduces the part count, simplifies the plumbing, and lowers the weight of the engine.
The engineering trade-off is that it requires incredibly advanced metallurgy to survive routing those ultra-hot main combustion gases through the turbine blades without melting them.
And let's talk about the plumbing required to feed those engines, because the scale is mind-blowing.
They recently completed qualification testing on the liquid oxygen transfer line for the Eclipse first stage.
During ascent, this massive pipe feeds cryogenic liquid oxygen to the Miranda engines at a volumetric rate equivalent to draining 300 bathtubs every single minute.
The fluid dynamics required to pump a cryogenic liquid at that velocity, preventing pressure drops that could cause the liquid to flash boil into a gas and destroy the pumps, is world-class engineering.
The development timeline for Eclipse is aggressive. They are targeting the delivery of the first stage to Northrop Grumman later this year.
The ultimate goal is a full Firefly-built variant utilizing both a Firefly first and second stage launching no earlier than 2027.
To offset the formidable capital requirements of building out new launch sites for these vehicles, Firefly is executing an asset-light international franchising model.
Instead of pouring hundreds of millions of dollars of their own capital into pouring concrete and building launch infrastructure in foreign countries, they are partnering.
They are working with the Swedish Space Corporation to launch from the Esrange Space Center, and they are exploring a similar arrangement with Space One to operate out of the spaceport in Japan.
They essentially provide the rocket hardware and the launch operations software, and the local sovereign partner manages and funds the terrestrial infrastructure.
which is a smart capital allocation strategy, but it raises an important point regarding their near-term financial profile.
Yeah.
And we need to look at the margin drag.
While the launch business is undeniably the sexiest part of the company, it provides the visual spectacle and the headlines. It is incredibly capital intensive.
That $79 million in quarterly cash flow burn we discussed earlier, a substantial portion of that is funding the Alpha Block 2 test upgrades.
And expanding the manufacturing footprint in Texas to support the AFP machines and the intense hardware-rich Eclipse development program.
It is a race against the balance sheet.
It absolutely is. Management has stated they expect to launch another 3 times this year, bringing the total to 4 Alpha launches in 2026.
If they miss that execution cadence, if weather delays them in Vandenberg, if a supplier issue holds up a valve, or if another anomaly forces a secondary stand-down, the launch division will become a heavy financial anchor.
It will drag down the profitable, high-margin software and spacecraft segments they are working so hard to cultivate.
Which brings us perfectly to the investor context. We have to look at the 2026 guidance and the broader macro setup to see how Wall Street is pricing in all of this concurrent risk and reward.
Management laid out a very bold, forward-looking guide on the call. They are projecting 2026 full-year revenue to land in the range of $420 million to $450 million.
If you take the midpoint of $435 million, that represents a 172% year-over-year increase from 2025.
172% growth at a $500 million scale is phenomenal. But as an experienced investor, you immediately have to ask, how de-risked is that number?
Because in the commercial space industry, forward guidance is often treated by analysts as a fantasy until the rocket actually clears the tower.
This is exactly where the spacecraft and the SciTec software pivot saves the narrative. Management noted a substantial vote of confidence during the call. 80% of that $435 million midpoint is already booked in their existing backlog.
So it isn't speculative demand, it is contracted revenue.
However, actually recognizing that revenue and converting it from backlog to the income statement requires flawless execution. It is execution risk, not demand risk.
They have to hit the 3 remaining Alpha launches. They must execute on the highly complex Blue Ghost lunar missions, and they have to meet the stringent percentage of completion milestones for the SciTec defense software programs without cost overruns.
And you cannot ignore the cash flow realities staring you in the face. Capital expenditures are going to increase above 2025 levels.
They're building out clean rooms, partly funded by the Texas Space Commission, to handle the lunar lander manufacturing cadence.
Furthermore, there is a final cash payment of approximately $24 million due in the second quarter related to the finalization of the SciTec acquisition.
Management explicitly stated the cash usage will increase slightly in the coming quarters before it stabilizes.
Which defines the current equity story perfectly. The stock is currently down roughly 48% from its $45 IPO price back in August of 2025.
The market punished the early hardware volatility. However, it is showing real near-term strength, up over 16% over the last month, significantly outperforming broader space and defense sector ETFs.
The market is treating 2026 purely as an execution year, not necessarily a profitability year.
If they hit the 4-launch cadence, if Blue Ghost 2 lands safely on the far side of the moon and establishes that comms relay, and if the Forge software continues to perform for the Space Force, the multi-year narrative expands drastically.
Analysts will begin modeling out the space data center thesis. But if they stumble, if a rocket is grounded for 6 months, the market will mercilessly punish the cash burn, and the stock will retest its lows.
It is a completely binary setup. The $893 million in liquidity buys them time to execute the pivot, but it doesn't buy them infinite patience from Wall Street.
Very true.
Okay, let's unpack this and have some fun with the mechanics.
Yeah.
We're going to transition into our This Is Not Financial Advice segment.
Here we go.
I am taking off the objective host hat and putting on the aggressive, highly speculative hedge fund pod analyst hat. I am pitching the investment committee right now, and everything I say from here on out is for informational and entertainment purposes only. Do your own due diligence.
The floor is yours. Let's hear the pitch.
I am calling this trade setup the defense disruption spread. We are setting up a pairs trade based entirely on the massive paradigm shift happening right now in Department of Defense procurement.
Okay, tracking.
We just saw a 50-year legacy monopoly broken by the Forge software contract. The DoD is screaming for commercial speed.
They are actively trying to pivot away from the decade-long cost-plus procurement cycles of the legacy primes and towards commercial entrants who can iterate software updates over the air to orbital assets.
The macro setup makes sense, right?
It does. What are the specific legs of the trade?
For the long leg, we are buying deep out-of-the-money ELIPS long-term equity anticipation securities, essentially long-dated call options on Firefly, ticker FLY.
What? Struck.
We are targeting strike prices around the $33 to $35 level, expiring 18 months out. This aligns with the recently upgraded analyst price targets from Roth and Morgan Stanley.
Got it.
The thesis here is asymmetric upside. If Firefly hits that 4-launch cadence and Blue Ghost 2 touches down, the market will realize that the $1.4 billion backlog is translating into actual operating leverage.
Yeah, when that realization hits, you get a violent multiple expansion as analysts reprice the company from a capital-intensive hardware space company to a high-margin defense AI and orbital data center platform.
Exactly. But long-dated options are notoriously expensive, and time decay theta is your enemy while you wait for these complex hardware missions to execute.
How are you funding the premium on those ALAPs?
We fund the long options by shorting the past. We short a customized, equal-weight basket of the legacy, slow-moving terrestrial defense prime contractors.
Or, to manage the borrowing costs and make it simpler, you could sell out-of-the-money call options against a broad defense and aerospace ETF.
The rationale being that the $185 billion Golden Dome architecture inherently demands AI-enabled on-orbit edge processing, the exact capability Firefly now owns and is integrating via SciTec.
The legacy primes simply cannot iterate software fast enough to compete in this new domain. They are structurally trapped in hardware-centric terrestrial procurement cycles, while companies like Firefly are operating at commercial speeds.
Exactly. The legacy primes are bleeding market share to the commercial space entrants in the high-growth technological domains. And the absolute beauty of this trade is the downside protection embedded on the long leg.
You're talking about the cash buffer.
Firefly's $893 million liquidity position acts as a fundamental floor on the stock price. It completely eliminates the need for a near-term dilutive capital raise or secondary stock offering, which is the #1 event that usually crushes long equity positions in early-stage aerospace.
The cash buffer gives the thesis the runway it needs to play out, while the legacy short position funds the theta decay.
It is aggressive, it is highly speculative, and it relies on flawless hardware execution, but the underlying logic regarding the structural shift in DoD procurement is sound.
And again, that is not financial advice, just a theoretical exploration of the market mechanics at play.
Let's recap the primary themes of this deep dive before we sign off.
We are looking at a company undergoing a rapid, high-stakes transformation. You have unprecedented top-line growth, 541% expansion in a single quarter, driven by a genuinely strategic software acquisition in SciTec that anchors them to critical national security architecture and smooths out their revenue recognition.
But that growth is heavily counterweighted by the punishing gravity of their operating expenses. The $79 million in quarterly cash flow burn means that hitting their 2026 execution milestones, specifically that 4-launch alpha cadence, validating the Block 2 upgrades, and executing the Blue Ghost Lunar missions, is an absolute existential necessity to bridge them to the medium-lift future.
And as a final reminder to our listeners, Talk Tickers is for informational purposes only, and nothing discussed today should be construed as financial advice.
For those of you tracking this narrative, keep a very close eye on the backlog conversion rates when the Q1 numbers drop. That will be the ultimate operational tell on whether the launch hardware, the lunar infrastructure, and the newly acquired software segments are actually integrating smoothly.
It'll be a fascinating quarter to watch.
And I'll leave you with this final provocative thought to mull over. If Firefly successfully builds out this orbital data center architecture, utilizing Elytra orbiters to process SciTec AI algorithms in the vacuum of space, who actually controls the legal sovereignty of that data?
Oh, that's a wild thought.
When the intelligence processing happens in orbit, outside of any terrestrial borders or jurisdictions, the commercial company that owns the orbital toll booth might eventually end up wielding more geopolitical leverage than the nations buying the data.
Something to keep in mind for sure.
Until next time, keep digging into the numbers.